what is 5-step model of revenue recognition under IFRS 15 and how to apply it. I am Silvia of cpdbox.com, and here I will demonstrate this for you. So a few years ago, IFRS 15 introduced this model, which you have to apply for all of your transactions, and we're going to see the example from telecom industry here, but really, if you apply it analogically to any situation, that will work. So, quick overview. These 5 steps are: number 1, identify the contract with the customer. Number 2, identify individual performance obligations in that contract. Number 3, determine the transaction price. Number 4, allocate that price to the individual performance obligations. And the last step, number 5, recognize revenue when or as the entity satisfies performance obligations. And IFRS 15 sets details for each of these steps, so if interested, watch our summary video here or visit my website, cpdbox.com. So let's take a look at the example. Let's say that some telecom company, ABC, entered into a contract with Johnny, where Johnny subscribes for ABC's monthly plans for 12 months, so he will use their telecom network, and as a bonus, he receives free mobile or handset from ABC. Johnny will then pay monthly fee of 100 currency units. Johnny gets the handset immediately after the contract signature. So here's additional information. ABC sells the same handsets for 300 currency units and the same monthly plans for 80 currency units per month without handset, and we will need this information somewhere later. How would this company account for that contract? Well, let me tell you, you cannot treat a mobile phone as a marketing cost. That's wrong, and this is exactly what changed in IFRS 15 from previous standards. So let's go step by step and start with step number 1, identify the contract with the customer. Here it's clear, very straightforward, because ABC has a written contract with Johnny. Let's move to step number 2. Identify the performance obligations in that contract. These are simply the promises that a telecom company promised to Johnny in that contract, and we have 2 here. The first one, network services or connection for 12 months, and the second one is phone that the company gives to Johnny right away after signing that contract. I'm not going into details of each step here. You can see that in the other videos or on my website too. So this is just a basic demonstration, right? Step number 3, determine the transaction price, which simply means to determine how much will Johnny pay to the telecom company during that contract. So here's our contract. We can see that Johnny should pay 100 currency units per month over 12 months. So the total transaction price is 1,200, which is 100 multiplied with 12. Step number 4, allocate the transaction price to individual performance obligations, and this is where it becomes interesting. So from previous step, we know that the total transaction price is 1,200, and we need to allocate it based on the relative standalone selling prices. To do that, we firstly set up a simple table like this one, where all performance obligations are listed. So you see network services and phone here. And what about the standalone selling prices? Here's where the information about ABC comes handy. You have seen this already. So standalone selling price is simply the price at which ABC would sell the handset and network services separately. So it's 380 per month respectively, and we can insert these numbers to our table. 300 for handset and 80 per month times 12 months, which is 960 for 1 year of the same network services if sold without handset, right? And a total of standalone selling prices is therefore 1,260. Now, once we have that in the table, we can allocate the transaction price of 1,200 to the handset and network services based on standalone selling prices. So, to handset, we allocate 285.70 currency units, and you can see the calculation right here. It's simply standalone selling price of a handset of 300 divided by the total of standalone selling prices of 1,260 times transaction price of 1,200. Similar calculation applies for allocation to network services. Yeah, so we get the amount of 914.30 for 12 months. And if you allocate it correctly, your total should come to the transaction price of 1,200 currency units. Now, when it comes to revenue, this comes from allocated transaction price. Revenue from handset is therefore 285.70 currency units, not zero, just because the contract says it's free for Johnny. IFRS 15 requires you to recognize some revenue based on allocation, but not zero. With regard to revenue from network services, ABC recognizes the allocated amount of 914.30 over 12 months, which is 76.20 per month. The total should give you 1,200 currency units. Now, here the complication is that the billing or issuing invoices to Johnny is different from these numbers, because there is no invoice for handset, that's zero, and invoices for 100 currency units each month. So how to deal with that difference? I will show you later in journal entries. Step number 5 is to recognize revenue when or as the performance obligation is satisfied. So here we are talking about when to record the appropriate journal entries. There are two options, either over time or at the point of time, depending on how the services are provided or how the performance obligations are satisfied. So again, more about it in my other videos or on my website. For now, we can say that network services are satisfied over time, over 12 months, and the phone is given to Johnny at the point of time, right in the beginning of the contract. So now we know everything to draft the journal entries. First of all, when the company signs the contract and gives phone to Johnny, it records credit revenues in profit or loss from the sale of phone with 285.70 currency units. And where is this number coming from? Well, that's why we did that exercise with allocation. So look back to the table from step number 4. It is right here, the amount allocated to the mobile phone. Now, we don't have any cash from Johnny, so what's the debit? That would be the contract asset, not receivable, but contract asset. If you'd like to know the difference, please watch this video linked right here and in the description. I just remind you not to forget to book cost of sales to remove the phone from inventories. So that would be debit cost of sales and credit inventories with whatever the cost of the phone is on the warehouse. Now, what about monthly services? In this type of services, it's okay to book revenues on monthly basis together with invoice. So you need to debit receivables because you actually send invoice to Johnny with 100. And then you recognize monthly revenues from network services of 76.20 currency units, not 100, because a part of it relates to the phone. And again, the number 76.20 comes from the allocation in step number 4. You can see it right here. Well, now our entry is not balanced. There is a difference of 23.80 currency units. So guess what? We credit the contract asset with 23.80. And believe me that over 12 months, if you pass the same entries, the contract asset, which was initially 285.70, will decrease to 0. So the whole point is to recognize revenue also for the free mobile when you give it to the client and the lower revenues from network services. Like this video if you find it useful, share it, and visit my site for more stuff like this. Sign up to my newsletter and learn. Bye!